So addressing the question of are we in some sort of AI bubble or blockchain bubble right now, the bottom line is that even though I've assessed the arguments for, I have to come down and say the bottom line is I do not believe this to be the case. Now, we don't believe this to be the case for a number of reasons. Right? The first is that at an industry level, we have never seen any single one of these cycles of investment in capital stock, right? Whether, again, you're talking about electrification, railways, canals, internet telecom companies, this is all building capital stock. We've never seen one of these cycles end when the return on invested capital is positive. Now, currently, if you look at what's happening, we can see that Microsoft, according to its own annual report, has about a 67% profit margin on its data center business. So that is so far from being in a negative position that we literally have to think about this being years from now, if we're even entering into that sort of a situation. Now, the other thing we have to think about is the sheer volume of investment in capital stock has typically peaked at around 6% of GDP. And based on a number of sources that I have, we can see that the capital investment in the United States is about 2% of GDP. So we probably actually have to see about 3 times the annual rate of investment to really get into that, air quotes, that bubble stage. So if we're going to evaluate this, we're looking for a negative return on invested capital, and we're looking for a very, very large amount of capital expenditure. And the bottom line is we're just not seeing any of those factors. Right? The second thing that we have to look at is that many of these arguments in and around bubbles have to do with comparing current valuation metrics in the market to long-term average valuation metrics in the market. And the problem with that is you are comparing apples to oranges because the indexes change. The indexes are not fixed. The largest stocks in the S&P 500 index from 10 years ago are very different than the largest stocks in the S&P 500 index from today. And the bottom line is that over the last 40 years, companies have really gotten better at being companies. We know that the profit margin has increased substantially since the 80s. We know that the level of corporate debt has come down. We know that profit margins are higher. And so if the quality of a business is higher and the debt is lower, they deserve to trade at a higher multiple. There is no way that, for instance, a company like ExxonMobil, which has a much lower profit margin than, again, Microsoft, should ever be trading at the same multiple. Microsoft should have substantially higher valuation than ExxonMobil. If it doesn't, then the market's is undervaluing Microsoft. So another thing when you're talking about these valuation arguments is that you have to look, if we look at the general market, right, we can see that NVIDIA trades at about 30 times forward earnings. If I look at my Refinitiv terminal here before I videoed. The bottom line is that Costco trades at 50 and Walmart trades at about 32 times forward earnings. So if NVIDIA is symptomatic of an AI bubble, then Costco is also symptomatic of a double bubble in shopping clubs. Now, I don't think either of these are the case to be true, but we also have to take a look around, and just because something's gone up doesn't mean that it's a bubble, right? And we also have to remember that returns recently have been strong, but nothing like what we saw in the late 90s. In the late 90s, we saw 2 years in the NASDAQ, where the NASDAQ 100, where the returns were north of 90% per annum. And we've had a couple of good years, where the S&P is up 20+%, is up in the mid-teens year to date, right? But it's nothing like what we saw at the going into the peak of the internet bubble. So again, we'll be watching out for that. We will be watching out for, again, valuations that do get detached. Again, if we take a look at the internet bubble, we do see that Cisco Systems went from 50 times earnings to 210 times earnings, 120 times earnings, and that is probably not justified. However, we're just not there yet. So the bottom line is we're going to look at the assessment. We're going to continue to assess based on current conditions, and we're going to take the right actions. But the bottom line is we just don't think that there's a bubble right now. The evidence just isn't there to support it.